The Consolidation Playbook, Volume 1. Think like the banks. Alright, so let's get right into this. Starting off here, we have this diagram, this schematic. I know it can look like a lot of information, but we'll slowly start to break this down. So starting here on the left, through here, the banks are delivering price. This is seen by new liquidity highs and displacements created from inflows of large orders. So as we can see, this black arrow is delineating the fact that the banks are expanding through here. And we can see in these green lines, we've got a low, a high, a higher low, and then a higher high above this high, which is depicting exactly what is said here, that the banks are delivering price higher, okay? Now, once we reach this liquidity objective, what happens? We start to go into this back and forth range and we just consolidate, okay? So now, let's move on to here and let's understand a little bit more of why this happens and the smart money procedures behind it, okay? Book balancing. Once the liquidity objective is met, the banks must begin offsetting, hedging, and rebalancing exposure and risk between currency baskets. Stable flows of liquidity. If the depth of liquidity from low to high was 150,000 units and smart money offset 100,000 units above the liquidity objective, then that depth of liquidity becomes 50,000 units long, which smart money provides the opposing 50,000 units short through internal hedging, synthetic positions, cross-pair balancing, passive liquidity through liquidity providers and retail traders. So that 50,000 units left of buy pressure gets internally paired within the bank to flatten out the books and force equilibrium while they neutralize their risk. So both buy and sells are equal, causing stable flows of liquidity. Why this is important? These stable flows are used to prime liquidity for the next directional move. Consolidation will continue until new, larger, one-sided flows of liquidity are provided in the marketplace. And then I just said, stay tuned for the next episode, as we will touch more on this in the future, okay? This is just the baseline for now. So if we go back to here, now with all this data that we've just spoken about, we can see that we've had this expansion higher from the banks where there is larger inflows of orders, and we've taken it above this liquidity objective. So now the banks are going to start offsetting, reducing their risk, etc. So if this depth of liquidity from this whole expansion is 150,000 units, okay? And then once we get above this liquidity objective, smart money is offsetting 100,000 of these 150,000 units out of the market and, let's say, taking profits, okay? So then that leaves us with only 50,000 units of liquidity left, which starts to be traveled around in here. And the reason that it can't bump up any higher or bump up any lower is because with that 50,000 remaining units, let's say they're long and it's trying to push these longs, well, it is being met with internal pairing of 50,000 units short. So now we have the same amount of stable flow liquidity within 50,000 units up here and the same stable flows of liquidity within 50,000 units down here, as opposed from when we had this run before we met the liquidity objective and we had a depth of liquidity of 150,000. Well, now we're just being trapped in the stable flows of liquidity between these two 50,000 units on the buy and sell side. But let's go to the next slide now. Behind every consolidation. So here on the charts on this left side, we've got the USD dollar, and on the right side, we've got the USD 1 hour. We can see in these yellow shaded areas, I have depicted this current week's consolidation, this with all the daily candles, and then a more refined version where we can see more candles on the hourly and get a better base for its consolidation and range bound movements. As I say, here we are specifically focusing on Forex today for this thesis. Let's get into these things here at the bottom. What was seen in price to cause a consolidation? Previous week expansion price profile. Okay, so if this is the current week, this was the previous week, where we can see that every day was just an up close candle. We had a real big expansion. This is problematic for following consolidations because markets move in sequences. We don't just go expansion, 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 reversal. You know, we go expansion, expansion, maybe again, and then we go into a consolidation, and then from there we might get a retracement, and then we go into expansion, and then back to consolidation, as everything moves in sequences, which I have mentioned in one of my core content topics on the YouTube. The second is liquidity objective met. We can see that after this previous week's expansion, we've got into this new week. We have pierced above this buy side liquidity on this high and into the inefficiency of this area here. So once the draws have been met, the market doesn't really know what to do and can go into consolidation. Price is at equilibrium of the dealing range. So we have our range high and our range low down here. If we measure this with a fib, our Fibonacci would be right here, which is right where price is consolidating, as price tends to consolidate at equilibrium of ranges, okay? These we'll touch much more on, but let's just continue to move on here. What are the banks doing that creates consolidation? Balancing books. Banks reduce large positions after hitting a liquidity objective, bringing their exposure back to neutral. When they stop pushing price and start flattening risk, the markets naturally move sideways. Internal hedging. Instead of sending orders into the market, banks pair their own buy and sell flows internally. This creates equal pressure on both sides, which forces price into stable, directionless movement. Offsetting flows. Banks absorb client orders, retail trades, and passive liquidity by taking the opposite side. Because every buy is met with a sell, price has no reason to trend, so consolidation forms. Correlation in consolidation. So here on this chart, we can see that I have the 1 hour dollar index chart here, and you can see that we have the actual candlesticks, black and green, that depict the dollar index. And then I have written out in colors here all the other lines that match the specific assets, okay? And we have marked out the week of the recent week that we're talking about where DXY consolidated. And you can just see how, while everything was a bit sloppy and choppy, that not everything moved perfectly in sync and correlated as it should. Okay, so let's get into that. Cross-asset portfolio balancing. Banks balance portfolios of currency baskets, but each asset inside that portfolio has its own book and is being balanced differently. This is why one asset can consolidate while others can trend. This can occur as banks flatten USD exposure. They might hedge using CAD. Independent microflows. The other reason is microflows inside of each asset. AUD follows commodities, Canadian dollar follows oil, Japanese yen follows risk sentiment, gold follows volatility, indices follow positioning, and crypto follows liquidity pockets. This is why some markets consolidate, some drift up, some drift down, and some completely just decouple. Expect inconsistent correlation, shallow trends, fake outs, and assets drifting on their own flows. This is not a very inviting environment and is best avoided. But crosses love to run. When USD is consolidating, smart money is not delivering price in USD. So they deliver price through the crosses instead. When DXY is in stable flows of consolidation, USD pairs such as Euro USD, GBP USD, AUD USD, etc. can't trend properly because one side of the pair, USD, is not moving. But the crosses which do not have USD in the pair are not held back and still free to move around based on their own book balancing and individual micro inflows. So as we can see here, I've got the Euro GBP pair on the crosses, which has no USD in it. And I have labeled out the exact same time frames that we have been on all of these charts, which was the most recent window of the week. And we know that the DXY was consolidating, which was making the majors consolidate or in real fuzzy price action. But look at what we see here on the Euro pound pair on the crosses. It's just expansion. Okay, so when to expect consolidation and why? After a previous or several previous expansion candles, this is because price profiles move in sequences. When a drawn liquidity objective has been met, At equilibrium of dealing ranges, after both sides of the range have been reached, during certain time windows, lack of or anticipation of macro driver. After the market has reached a measure of fair value, it tends to go into consolidation as smart money balance their books and build new liquidity to fuel the next price profile of delivery. With no incentive to reprice the asset, the algorithm pauses and manufactures liquidity until a new imbalance or liquidity objective appears. This occurs around and based off certain time windows and macro drivers. Now, what to do? Ideally, avoid trading altogether and wait for more clear conditions. This is the number one rule that I recommend and will always be your saving grace in this case, okay? But if you do want to be a bit impulsive and you do want to trade, avoid taking any trend trades, okay? And reduce risk. So you don't want to be looking for any trends. You understand the market conditions are range bound, they're in consolidation right now. So we just want to be focusing around that and using models that deliver well in these conditions rather than looking for trend trades in a non-trending environment. And then also you just want to reduce your risk. If you know the market's a low probability and, you know, lacking certain substances, just reduce your risk, okay? However that is in your risk management plan, I would just reduce it. You know, personally for me, I would reduce it 50% at least. So then finally, opt to speculate the crosses rather than the majors. As I've mentioned several times now, DXY consolidation, majors, choppy price action, crosses, big thumbs up. All right. So that's the order of operations of how that goes. So that is everything for you today, guys. I hope you found value in this. I hope I wasn't too advanced, considering I was trying to make it rather beginner at the same time, but while giving a good amount of context. And I want to just leave a little bit on the table if, you know, we decide to do a number 2 and you guys really want the more advanced stuff. All right. So anyways, I had a pleasure speaking with you guys. Thank you for watching. I hope you enjoyed and found value in this, and I'll talk to you in the next one. Ciao.